Welcome to Talk Tickers. So today we are jumping into a deep dive on a really fascinating corporate earnings call. We're looking closely at the Gap Inc., specifically their Q1 2026 earnings call, which happened on May 28th.
Yeah, and this one is, it's a real roller coaster.
It really is. I mean,
Right.
Usually when you look at a diagnostic x-ray, you expect precision, right? Like you break an arm, the image shows a jagged white line, and the diagnosis is totally definitive.
Right, it's binary. It's either broken or not broken.
Exactly. But stepping into this Q1 2026 earnings report for Gap feels like looking at an x-ray where the bones are healing, the surrounding tissue is actively deteriorating, and the doctors are, somehow claiming the patient is ready to run a marathon.
That is a brutally accurate analogy.
Right, because we are looking at a massive, glaring contradiction today. Our mission for this deep dive is to cut through all the Wall Street jargon and figure out how a retailer lowers its sales expectations for the rest of the year, like explicitly admitting they're going to move fewer units, but simultaneously raises their profit outlook.
Yeah, it looks like a complete optical illusion on paper. I mean, we are looking at an absolute masterclass in financial engineering here.
And it's masking some severe operational friction. So if you just glance at the top line data, the headline numbers, you see a company reporting Q1 net sales of $3.5 billion.
Which is up 1% year over year.
Yeah, up 1%, with comparable sales, or comps, coming in at a solid 2%.
And we should note that marks their 9th consecutive quarter of positive comps.
Right, so on the surface, the patient looks stable.
They do, but those consolidated numbers are hiding extreme volatility across their specific brands.
Absolutely.
Huh.
But before we even get to the brand level friction, we really have to talk about the EPS illusion. This is where I think retail investors get caught looking at the completely wrong metric.
Oh, the earnings per share discrepancy here is wild.
It is. The headline press release screams an EPS of 90 cents. But if you are sitting at home and you model your forward projections on that 90 cents, you are going to get slaughtered.
Yeah, you really are. Because the adjusted EPS is only 38 cents.
38 cents, which is actually a pretty significant step back from the 51 cents they posted in the exact same quarter last year.
So let's translate this chasm between the 90 cents and the 38 cents for everyone listening. It's purely structural noise.
Right.
Gap received a massive $313 million net gain from a legal settlement this quarter.
Wow.
Yeah, and then they paired that with a concurrent $50 million charitable donation.
So they essentially use the legal windfall to fund the donation.
Exactly. And the net of those two non-operational events flowed directly into the reported earnings. So you get this artificially inflated 90-cent figure.
I mean, a massive one-time cash injection from a lawsuit tells you absolutely nothing about the underlying profitability of, selling denim and fleece.
Right, especially in a highly competitive macro environment. When you strip away that legal windfall, you are left with that 38 cents.
And that decline from 51 cents down to 38 indicates real pressure on their core operational profitability.
It does. And those pressure points are highly visible in the gross margin, which landed at 40.5%.
Which is down 130 basis points from last year.
Mm.
Now, wait. Normally, 130 basis point contraction in gross margin points to a retailer losing pricing power, right?
Usually, yeah. It suggests they are heavily promotional, like desperate to clear aging inventory.
But the CFO, Katrina O'Connell, was super adamant on the call that this wasn't a demand issue.
And to be fair, the data actually backs her up, provided you isolate the variables properly.
Okay, walk me through that.
So merchandise margins took a direct, brutal 200 basis point hit purely from tariffs.
Tariffs. So that's an external shock.
Exactly. It's an external shock to their cost of goods sold. It is effectively a massive tax levied on their supply chain before the clothes even reach the distribution centers.
Well, okay. So if you run the hypothetical and strip out that 200 basis point tariff penalty,
then underlying merchandise margins actually expanded by 100 basis points.
Oh, that changes the picture completely. So the core pricing mechanism is actually functioning well.
It is. They aren't buckling under consumer pushback. In fact, their average unit retail, or AUR, increased across all four of their brands.
So they are successfully commanding slightly higher prices per unit.
Yes, but the macro trade winds are just eating those gains alive.
Right, the tariffs.
Yeah.
But that higher AUR, coupled with the underlying margin expansion points to highly disciplined inventory management.
Very disciplined, and a strategic reduction in discounting. I mean, they are walking a very tight rope here.
Yeah, they're selling slightly fewer units, but extracting more value per transaction. which is, a healthier way to run a retail business.
Definitely healthier, but it leaves them highly exposed to those external supply chain shocks like we just saw.
Right. Which brings us to the actual floor of the stores. Because viewing Gap Inc. as a $3.5 billion monolith is just completely useless right now.
It really is. A tale of two brands, basically.
Exactly. Beneath that steady 2% comp growth is a radically divergent reality. Let's start with the outlier on the upside.
The Gap brand itself.
Yes, the Gap brand posted a 10% comp increase.
Which is huge.
It is huge.
Yeah.
And that's lapping a 5% comp growth from the same quarter last year. That's 10 consecutive positive quarters. The brand is legitimately accelerating.
It represents a massive shift in their value proposition. I mean, for the better part of a decade, the Gap brand was just bogged down in utility apparel.
Right. Basic functional clothing that people only bought when it was marked down by like 40%.
Exactly. But CEO Richard Dixon has aggressively shifted that paradigm from utility to cultural relevance.
Yeah, he leaned heavily into that cultural playbook on the call. He highlighted the Coachella Hoodie House activation.
Oh yeah, the custom hoodies.
Right. They moved 10,000 custom hoodies and generated 300 million impressions. He also pointed to dressing Kendall Jenner at the Met Gala in a Zach Posen custom dress.
And trending on TikTok with a campaign featuring young Miko.
The psychology here is just fascinating to me. Why will a consumer balk at a $30 seasonal dress but eagerly buy a $100 custom hoodie?
Because the hoodie is no longer just cotton, it's cultural capital.
Cultural capital, like that.
By inserting the brand into Gen Z's digital and physical spaces, music festivals, high fashion galas, TikTok algorithms Gap is reclaiming the cultural zeitgeist they held back in the 90s.
Right, the 90s Gap was iconic.
Exactly. And when you lead with cultural capital, the consumer's price sensitivity drops dramatically.
So that's how you achieve a third consecutive quarter of reduced discounting. You aren't bribing the customer to walk in the door anymore.
Precisely. They actually want to be seen in the brand.
And they are executing on the product side too, just to back up the marketing. They drove growth in women's, maintained consistency in men's, and finally saw a return to growth in kids and baby.
Yeah, reclaiming market share in core destination categories like denim.
But, and this is the big pivot, as impressive as the Gap brand sprint is, it cannot offset the sheer gravity of Old Navy.
Old Navy is the volume engine for the whole company.
Right. I mean, it generated $2 billion in net sales in Q1 alone. It is the dominant specialty apparel retailer in the U.S.
But a 1% comp for a brand of that immense scale is essentially stalling out.
Yeah, it's like running a relay race where your anchor runner trips over their own shoelaces right at the finish line.
That's a great way to put it.
Dixon admitted they fundamentally missed the spring transition, specifically in women's seasonal dresses.
Yeah, he cited a failure in the, quote, fashion and value equation.
Which we hear constantly on earnings calls, right? But what are the actual supply chain mechanics behind a miss of that magnitude?
So it's basically a cascading failure of lead times and forecasting.
Okay, break that down for us.
A seasonal dress assortment is designed, and the fabric is committed to anywhere from 9 to 12 months in advance.
Wow, a whole year.
Almost, yeah. You are placing bets on silhouettes, prints, and color palettes nearly a year before the consumer ever even sees them.
That's incredibly risky.
It is. If you misread the upcoming trend maybe you bet on a bohemian aesthetic when the consumer actually wants minimalist structural pieces. You are trapped.
And because dresses have such a short seasonal shelf life, you can't just, hold the inventory in the back room until next year.
Precisely. You have an extremely narrow, roughly 8-week window to sell a spring dress at full margin.
Just 8 weeks.
Yeah. If the consumer rejects the fashion side of the equation, they just don't like the look. The only lever you have left to pull is the value side.
So you have to aggressively mark it down to clear the floor for the fall delivery.
Which crushes your margins.
And it tanks your digital metrics too.
Yeah.
The CFO explicitly stated that dresses heavily over-index online.
Right. People buy dresses online more than a lot of other categories.
So a failed dress program doesn't just hurt the physical store, it destroys online conversion rates.
Now, to be fair, the core foundation of Old Navy remains somewhat stable.
Right. Denim, activewear, kids, and baby all posted growth. They maintained their top 3 market share ranks.
But the seasonal miss was severe enough to require immediate intervention. They just appointed Michael Francis as the new chief customer officer.
Pulling him from roles at Target and Walmart.
Yeah, and the strategy there is obvious. They need someone who knows how to scale cheap chic.
Cheap chic, yeah. Infusing value apparel with aspirational branding.
Exactly. But fixing Old Navy's seasonal forecasting is a longer-term project.
It is. And meanwhile, they have an absolute crisis on their hands with Athleta.
Oh, Athleta. A negative 11% comp in Athleta is frankly the most alarming metric in the entire transcript.
Negative 11%. I mean, they are operating in a premium women's activewear market that, while competitive, still has significant pockets of growth.
Right, so dropping 11% means you aren't just facing macro headwinds, you are actively hemorrhaging market share to your competitors.
Lululemon, Alo Yoga, those guys are just eating their lunch.
Pretty much. Management framed this as a rebuild year under the new brand president, Maggie.
And they said they are currently focused on clearing less productive legacy product.
Which is a very polite way of saying the previous leadership designed a massive amount of inventory that Target consumers outright reject.
Yeah, they just don't want it.
And clearing legacy product in a premium brand is incredibly toxic to brand equity.
Because it ruins the premium feel.
Exactly. If you want to maintain a premium AUR in activewear, your stores cannot look like a liquidation center.
Oh, right. Racks and racks of clearance tags.
When you flood the floor with deep discounts to clear out mistakes, you train your core high-value customer to only shop during clearance events.
And it probably takes years to break that consumer habit once you introduce it.
It really does. And management actually admitted the turnaround here is taking significantly longer than they initially modeled.
They did point to a few green shoots, though, right? Like the Journey Travel collection and some new leg shapes in the Elation line.
Yeah, but those are very minor wins against the backdrop of an 11% contraction.
Fair point. So to recap the operational side, we have a surging Gap, a stalled Old Navy, and a deteriorating Athleta.
Which brings us right back to that initial contradiction regarding their guidance for the rest of 2026.
Let's get into Section 3, management guidance. Because of Old Navy's massive weight, management had to moderate their full-year net sales growth down to just 1% to 2%.
With Q2 expected to be flat or even slightly down.
So they are openly acknowledging that top-line revenue is impaired. But in the very same breath, they raised full-year EPS guidance to a range of $2.30 to $2.30.
Yeah, the profit paradox.
If you're selling fewer clothes and Athleta is stuck in a margin-crushing liquidation cycle, how on earth are you planning to make more money per share?
Well, engineering a higher EPS in this environment requires aggressive capital manipulation.
Are they sandbagging, or is there a trick here?
It's financial engineering. The CFO outlined $150 million in SG&A savings, which obviously helps.
Right, selling, general, and administrative expenses. So you trim corporate overhead, optimize marketing spend, squeeze efficiency out of the payroll.
Exactly. But $150 million in cost cutting doesn't bridge the gap alone.
Unintended.
Yeah. The real mechanism here is the massive stock buyback program.
Okay, let's talk about the buybacks, because this is huge.
They have already deployed $400 million year to date to repurchase 16 million shares.
Look, I understand the basic math of buybacks. You reduce the outstanding share count. So even if the net income stays flat or dips slightly, the earnings per share look better because there are fewer slices of the pie.
Right, artificial inflation of the EPS.
But I really have to push back hard on this capital allocation strategy.
Go for it.
You have Athleta burning to the ground, down 11%. You have Old Navy missing critical seasonal trends because of supply chain forecasting issues. Shouldn't that $400 million be aggressively deployed into fixing the operational machinery?
You mean instead of buying back stock?
Yes. Hiring better predictive data analysts for Old Navy, or absorbing the margin hit at Athleta faster so you can clear the floor. Why manipulate the stock price when the underlying business so clearly requires capital to fix?
Look, it's a very fair critique, but you have to view it through the lens of their balance sheet. Okay. It's akin to a company buying up the available real estate around its own flagship store to artificially inflate the property value of the remaining lots.
Interesting analogy.
They aren't doing this instead of funding the business. They are doing it because they generate so much free cash flow. They have literally exhausted their high-return internal investment options.
Wait, really?
Yeah, they ended Q1 with $2.6 billion in cash.
$2.6 billion. Okay, that is a fortress.
Right. You can fully fund the Michael Francis turnaround at Old Navy. You can clear Athleta's inventory, and you will still have Hundreds of millions of dollars just sitting idle.
So the argument is that hoarding the cash provides no yield, so retiring shares is the most efficient use of the excess capital, even while divisions of the company are struggling.
Exactly. And honestly, it signals immense confidence from the board. You don't authorize an additional $600 million for future repurchases if you think the core business is fundamentally broken.
So they view Athleta and the Old Navy seasonal misses as temporary execution errors, not structural rot.
Precisely. They think they can fix it, so they are buying their own stock while it's cheap.
That confidence is also reflected in how they're handling the tariff situation moving forward. This was a highly specific, very tactical detail from the CFO.
Oh, the Section 122 ruling.
Yes. Because of a Supreme Court ruling in February regarding Section 122, Gap expects an $80 million benefit from tariff relief on goods received through July.
Which translates to roughly 50 basis points of margin relief.
And their decision on how to deploy that $80 million tells you everything you need to know about the current macro environment.
It really does, because they are not flowing that relief through to the bottom line to juice the EPS further.
Which they totally could have done.
They could have, but they are deliberately hoarding it as a strategic buffer.
Yeah, O'Connell stated they are splitting that $80 million into two buckets. The first $40 million is a contingency for fuel costs.
Right. So if global shipping rates spike or fuel goes crazy, they don't have to alter their guidance. They just absorb the blow with the buffer. Smart. But the second $40 million is the truly fascinating part. It is reserved specifically to fund aggressive promotions if the back half of the year gets highly competitive.
Think about what that really means for a second.
Okay.
If Old Navy struggles to fix its assortment by Q3, or if competitors panic and start slashing prices across the mall, Gap has a $40 million war chest ready to immediately deploy into price cuts.
Oh, wow. So they can defend their market share in a brutal price war without ever touching their promised profit margins.
Exactly. It's a pre-funded insurance policy against a retail recession.
And if fuel stays flat and the promotional environment remains rational,
Then that $80 million drops to the bottom line as pure upside later in the year.
that is an incredibly defensive, conservative posture for a company that just raised its EPS guidance.
It is, which brings us to the bottom line, the actionable reality for the retail investor listening right now.
Right. What do we do with all this data? The data we've unpacked presents two very distinct paths depending on your investment timeline.
Let's start with the bear case. I'll take the bear case. From a pure retail execution standpoint, the organic growth metrics, the top-line results are flashing major warning signs.
They definitely are.
You simply cannot sustain a retail empire through financial engineering and SG&A cuts indefinitely. At some point, the physical stores have to move volume.
Right. The top line has to grow.
And the ongoing deterioration at Athleta is a massive liability. Plus, Old Navy's inability to nail a basic seasonal transition exposes a real vulnerability in their core competency.
Forecasting is everything in apparel.
Exactly. And relying on the Gap brand to carry the cultural weight of the entire portfolio is a super high-risk strategy because, let's face it, cultural capital is incredibly fickle. What's cool today on TikTok might be dead tomorrow.
Very true. But let me counter with the bull case for the actual shareholder.
Let's hear it.
If you already hold the stock, you're looking at a fortress balance sheet. The downside risk is heavily mitigated by that $2.6 billion cash pile.
The cash is a massive safety net.
It is. Plus, they raised the dividend to 17.5 cents per share.
A solid yield.
And they are actively buying back stock with another $600 million authorized. The financial mechanics are robust enough to weather the operational hiccups. You are literally being paid a solid yield to sit and wait for Michael Francis to recalibrate Old Navy.
So, synthesizing this, if you hold the stock, the dividend and the buybacks create a really comfortable hard floor. You're being paid to wait.
Yep.
But if you're on the sidelines looking to buy in for aggressive growth, the trigger to watch isn't the Gap brand's next marketing campaign.
No, not at all.
The true bellwether is Old Navy's fall rollout. If they fail to correct that fashion and value equation before the crucial Q3 back-to-school season, that 1% to 2% growth target is just going to evaporate.
You have to watch the inventory levels at Old Navy closely in the next quarter. If their inventory growth outpaces their sales growth again,
It means the new assortment is failing.
exactly. And the discounting cycle will restart all over again.
So we've seen the sheer power of cultural capital today. Gap Inc. proved they could resurrect a dormant brand by aligning with Gen Z. leveraging Coachella and high fashion moments to sell huge volume without resorting to discounts.
It's a truly remarkable turnaround for the Gap brand specifically.
It is, but the provocative question this earnings report leaves you, the listener, to ponder on your own is whether cultural capital can be systematically engineered at scale.
That's the million-dollar question.
Can a corporate conglomerate take the precise organic lightning they caught with the Gap brand and artificially manufacture it for Old Navy and Athleta?
Or is the very nature of cool resistant to corporate engineering?
Right. Because if they can't scale that relevance across their $2 billion anchors, no amount of share repurchases or SG&A cuts will protect the top-line revenue in the long run.
Lightning rarely strikes twice.
Exactly. So keep an eye on those Q3 assortments, check your own portfolios, and we'll see you on the next Deep Dive.